And then on Thursday, we magically got green numbers in the morning, 2 days in a row. Gonna get spoiled here with all this luxury. MBS were up 13 basis points on the open, improved 8 while I was writing my morning post, actually. Bonds were modestly weaker in the overnight, but they held inside yesterday's range. Jobless claims coming in under 200,000. Again, certainly didn't help, but it is likely the inflation implications courtesy of the PCE component of the GDP data had a bigger impact. Jobless claims came in at 192,000 on a forecast of 200,000. It's 195 previously. Jobs numbers just keep holding up in there. GDP rose 3.2% at an annual rate in prior quarter. The BEA said the GDP core PCE price index portion of that was plus 4.3. It was 3.9 previous and forecast, so it came in hotter than expected. Personal consumption rose 1.4% again, which it rose 2.3% last quarter, so it rose less this quarter. But people are still spending money, which does not help inflation. Fourth quarter GDP rose 2.7% in the second revision. Third quarter growth was revised upward to 3.2%. Growth was driven primarily by inventory growth, which all that growth is pretty skeptical. Services spending rose driven by housing and healthcare. Government spending was revised upward as well. Personal consumption expenditures were revised downward from 2% to 1.4%. The PCE price index was also revised upward by 0.5 to 3.7, excluding food and energy. The index rose 0.4 to 4.3. Needless to say, not good news on the inflation front. However, we are talking about data that is far in the past at this point. The FOMC minutes shed some further light on the comments by Loretta Meester and James Bullard last week. A few participants stated that they favored rising, in quotes from the report, a few participants stated that they favored rising the target range of the federal funds rate 50 basis points at this meeting, or that they have supported the raising the target by that amount. The participants favored 50 basis points increase, noted that a larger increase would be more likely to bring the target range close to the levels they believed would achieve sufficiently restrictive stance, taking into account their views of the risk of achieving price stability in a timely way. The comment of a few would typically mean that there was more than just those two, because I would say that a few is generally 3, not 2. Several analytical financial models have said that the Fed funds rate should be at 8% if we really wanted to kill inflation, so there is some room to say that this is going to go well above 5%. Total value of U.S. real estate fell by 4.9% from its June peak fell about 4.9%, which is $2.3 trillion from its June peak, according to Redfin. At the end of the day, the 5.5 ended up at 99.55, which put us 22 basis points up on the day. 99.55, that puts us above the second floor, so we have 2 lines there at the bottom. So we're back on the graph. So at least that's something. We're back on the graph, and we can start looking at this stuff. So you have a floor at 99,845 and a ceiling at just over 100. So we'll have to see how the news plays out tomorrow. We also got some extra real estate news. Luxury home builder Toll Brothers announced earnings after the close yesterday. Earnings per share rose while revenues were up 4%. Okay, their revenues are up while mortgages are down like 70%, and they're still bubbling out. So I guess that's a interesting perspective there. Cancellation rate was surprisingly low at only 14%. Gross margins rose, so there's no evidence of price cutting or promotional activity in the luxury space. That was from Brent Nitrick. At the end of 2022, 9.3% of subprime borrowers, those with FICO scores less than 660. Wow, I guess in the car space, anything less than 660 is considered subprime. So 9.3% of people below 660 were 30 days or more behind on their car payments. This is the highest rate since 2010. In addition to being squeezed financially, it's probably because used car prices are falling. And when used car prices peaked, some dealers sold vehicles that were in very bad condition, making non-payment financially very advantageous and appealing. That was from econ70.com. More pain in the commercial real estate sector, particularly in office buildings. Columbia Property Trust, owned by PIMCO, who you might know as the people that used to own First Guarantee Mortgage, defaulted on $1.8 billion in mortgage notes on office buildings in New York, Boston, and San Francisco. Pricey locations, what are there, like 3 of them? We are also seeing defaults on mortgages for shopping malls. The commercial real estate sector's pain is driven by rising short-term rates. Anyone who has floating rates is feeling this pain, and also a sea change in office work. Note the SL Green keeps hitting new occupancy lows. Wow, tough for them out there. And also in the mortgage world, Wells Fargo has laid off hundreds of mortgage bankers this week. So now they're laying off mortgage bankers. So, in a time when you need money, you're laying off the salespeople. I guess they must not have been that good. Now we got a post from our sponsor at WellThatMakesSense.com, learning to write sales copy. So this is the last in the series. In writing copy for advertisement, often you get your reader in an emotional frame of mind as a result of the environment you have created. Logic is less important. So this is all about writing copy that appeals to the emotion of your reader. Learn more at WellThatMakesSense.com.